Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Radnet Inc. Annual Report. Radnet Inc. offers a wide range of businesses and services in the field of diagnostic imaging. The company operates two main segments, imaging centers and digital health. In terms of services, Radnet provides various medical imaging procedures such as magnetic resonance imaging, computed tomography, positron emission tomography, nuclear medicine, mammography, ultrasound, and diagnostic radiology. In addition to these services, the company also offers multimodality imaging services, which allow for a comprehensive approach to patient care. Furthermore, Radnet develops and sells computerized systems that enable the distribution, display, storage, and retrieval of digital images. This includes picture archiving communication systems and related services. The company is also at the forefront of artificial intelligence, AI in healthcare, developing AI suites to enhance radiologist interpretation of breast, lung, and prostate images. Radnet's solutions for prostate cancer screening are another key area of focus. Moreover, the company offers AI-powered health informatics solutions to drive quality, efficiency, and outcomes in imaging and radiology. Radnet also provides informatics designed specifically for outpatient radiology, as well as a cloud-native operating system called DeepHealth OS that helps with the operations of radiology services. Overall, Radnet's diverse range of businesses and services positions it as a leader in the diagnostic imaging industry. Radnet Inc.'s stock price has experienced a significant increase of over 34.36% in the past year due to several positive news events. One major contributor was the company's strong financial results, particularly its record revenue and adjusted EBITDA in Q2 2025. The acquisition of ICAD and C-Mode also played a crucial role, providing access to new healthcare provider locations and introducing AI-powered ultrasound tools. The company's continued strong performance was evident in its Q3 and Q4 2025 financial results, with record quarterly revenue and adjusted EBITDA. Radnet also revised its full-year 2025 guidance upwards for both revenue and adjusted EBITDA, indicating a positive trend. Furthermore, the acquisition of Gleamer, a radiology AI firm, has significantly expanded Radnet's AI capabilities and customer reach. The company's strategic moves to expand its digital health and AI capabilities have been well received by investors, leading to a surge in its stock price. With several high-profile acquisitions committed in early 2026, including centers in Southwest Florida, Indiana, and Virginia, Radnet is poised for continued growth and expansion. The company's focus on integrating AI technologies to enhance productivity and service offerings also bodes well for future success. Radnet Inc. maintains a market capitalization of $6 billion, broadly in line with the industry peer group. Radnet Inc. trades at a higher price-to-book ratio of 5.07 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 66% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of key financial metrics. On the growth side, favorable changes in working capital contributed $65.8 million to operating activities, while service fee revenue increased by 13.1% from 2023 to 2024. Commercial insurance and Medicare revenues also saw significant increases, with commercial insurance rising by 11.3% and Medicare increasing by 16.6%. These growth drivers suggest a positive trend in the company's financial performance. On the decline side, lower utilization at imaging centers led to closure and lease abandonment charges totaling $8.6 million, while increased employee contributions to profit-sharing/savings plans added another $7.5 million to expenses. These revenue decline drivers highlight areas where the company may need to focus on improving operational efficiency or adjusting its business strategy. In addition to these key drivers, other relevant points include acquisitions and recurring revenue targets. The company's acquisition of several radiological groups contributed positively to revenue growth, while achieving specified performance-based milestones helped meet recurring revenue targets. Overall, a careful analysis of these financial metrics provides valuable insights into the primary drivers of revenue growth or decline for the company. The net income of the company experienced a decline in 2025 compared to 2024, with a significant drop from $2,793 million in 2024 to -$18,652 million in 2025. This decrease was also observed in 2023 compared to an unspecified year, where net income fell from $30,337 million in 2023 to a higher value in 2022. In contrast, the company's net income increased in 2024 compared to 2023, rising from -$3,044 million in 2023 to $2,793 million in 2024. However, this increase was short-lived, as the company's financial performance declined significantly in 2025. The profit margins of the company also experienced a decline in 2025 compared to 2024, with no information available on revenue changes contributing to this decrease. In contrast, the company's profit margins increased in 2024 compared to 2023, with adjusted EBITDA rising from $232,344 in 2023 to $279,459 in 2024. The reasons for these changes in net income and profit margins are varied and complex. Decreased government spending on healthcare programs, increased labor costs due to minimum wage increases, inflation, and competition for staffing were among the factors contributing to the decline in financial performance. Additionally, economic downturn, high unemployment, inflation, rising interest rates, disruption of credit markets, labor shortages, integration costs, malpractice claims, unpaid accounts receivable, and inefficient capitation fee arrangements also played a role. The company's financial performance indicates a positive trend in its ability to generate operating cash flow. According to the provided data, the company has consistently shown an increase in cash provided by operating activities over the past 3 years. In 2025, the company generated $298,820 in cash from operating activities, which is a significant improvement from the previous year's figure of $233,023. This growth suggests that the company's operations are becoming more efficient and profitable. Furthermore, the net cash provided by operating activities for each year has also shown an upward trend. The data on page 53 and page 68 provides clear evidence of this positive trend, with the company generating a substantial amount of operating cash flow in recent years. This is a crucial indicator of the company's financial health and its ability to sustain itself over time. Overall, the available information suggests that the company is indeed generating positive operating cash flow. The company's debt level and interest expenses have undergone significant changes over the past few years. According to the extracted summaries, the total term loan debt increased by $11 million from December 31, 2024 to December 31, 2025. Additionally, the total debt rose from $351,464 in 2024 to $422,029 in 2025. However, long-term debt saw a slight increase of $79,244 from 2024 to 2025. On the other hand, interest expenses have been relatively stable or decreased in some instances. The interest expense as a percentage of total revenue decreased from 4.4% in 2024 to 3.4% in 2025. Furthermore, total interest expense and adjusted interest expense both saw decreases of $9,936, 12.4%, and $6,433, 8.2%, respectively, from 2024 to 2025. However, there are instances where interest expenses have increased significantly. For example, the interest expense rose by $15,366 from 2023 to 2024, before decreasing slightly in 2025. Overall, while the company's debt level has increased in some cases, its interest expenses have remained relatively stable or decreased in others. The performance of various regions and segments in the industry can be summarized as follows. Regions such as Arizona, California, Delaware, Florida, Maryland, New Jersey, New York, Southern California, Texas, and Virginia performed well. These areas saw significant growth and revenue increases. On the other hand, certain regional markets experienced challenges. Some markets faced a shortage of qualified radiologists, while others had non-enforceable non-compete covenants, leading to increased salary and professional services expenses for contracted radiology practices. Additionally, lease abandonment charges were incurred due to abandoning leases at 7 imaging centers. In terms of segments, the digital health segment performed well initially, with a revenue increase of $26.9 million, 41.1%, to $92.7 million. However, it later experienced losses, with segment profits ranging from -$15,282 to -$7,528. Radnet's management is optimistic about the company's outlook, driven by revenue growth in its diagnostic imaging equipment and technical services. The diversified revenue stream from commercial insurance, Medicare, Medicaid, and other payers provides stability. Capitation arrangements with health plans offer a stable source of revenue. The company has made significant investments in its software business, generating $39.3 million in revenue for the year ended December 31, 2025. Radnet also expects to recognize $0.8 million in revenue over the next 12 months from deferred sales. The management strategy involves expanding the digital health business segment through strategic acquisitions and integrating recently acquired businesses. Radnet is continuously monitoring collections and maintaining an allowance for credit losses based on historical collection experience, mitigating credit risks. The company has a debt facility with Dignity Health that will mature in 2026. Overall, Radnet's management is focused on leveraging its diversified revenue stream, expanding its digital health business segment, and navigating the regulatory environment to drive growth and profitability. The company has made several acquisitions and divestitures over the years. In terms of acquisitions, the company has purchased various diagnostic imaging centers and technologies from different companies. These include Aidence Holding BV, Quanta BV, Deep Health Inc., Caron Technologies, ICAD Inc., C-Mode Technologies, CIMAR, Montclair Radiological Associates, the HLH Imaging Group Limited, and several radiology practices. Additionally, the company has acquired ICAD Inc. and Kolb Radiology PC. The company has also made significant investments in various technologies and companies, including Caron for $2.3 million, Pacific Diagnostic Imaging Group, LLC, and Tri-Valley Imaging Group, LLC. These acquisitions are expected to enhance the company's capabilities and expand its services. On the other hand, the company has made some divestitures, although they are relatively few in number. The company has sold a 20% membership interest in Pacific Diagnostic Imaging Group, LLC, to Tri-City Healthcare District for $0.3 million. Additionally, the company has sold an economic interest in Ventura County Imaging Group to Community Memorial Health System for $5.1 million. The company has also closed some of its imaging centers, resulting in lease abandonment charges of $8.6 million in 2025, $2.5 million in 2024, and $5.1 million in 2023. These closures are likely a result of the company's efforts to streamline its operations and focus on more profitable areas. The financial overview of the company. A review of the company's financial records reveals some key points regarding its dividend payments. According to the information, the company has not paid any dividends in recent years, page 32 and page 37. This suggests that the company is prioritizing reinvestment in its operations over distributing profits to shareholders. In addition to dividend payments, the company's share buyback activities have also been examined. Unfortunately, there is no clear indication that the company has engaged in share buybacks. As a result, it appears that the company is not using this method to return value to its investors. Concerns about inventory buildup or supply chain disruption are present due to inflation and geopolitical instability. This has the potential to lead to shortages of materials, resulting in decreased revenues or increased expenses. While specific financial data related to these disruptions is limited, an increase in accounts payable, accrued expenses, and other liabilities by $52,416, 2025, and $37,117, 2024, suggests a notable impact on the company's finances. That concludes the financial summary for Radnet Inc. Feel free to comment below, and I will be happy to answer them when possible.